Could misguided political decisions trigger inflation that threatens Britain's entire economy, leading to a deadly stagflation where prices and growth collide on a dangerous path? Stay with me until the end to discover how Chancellor Rachel Reeves went from being Labour's rising hope to becoming, in the eyes of some of the world's largest financial institutions, her own worst enemy. The story begins when the National Institute of Economic and Social Research, NIESR, revealed that Reeves's budget faces a staggering shortfall of up to $50 billion. At the same time, the Bank of England announced that the government's current policies are pushing inflation higher at a worrying pace in slowing economic growth. Source: NIESR, Bank of England. It didn't stop there. New data suggests that interest rates may not fall as soon as expected. This means the cost of servicing Britain's public debt, now approaching $3 trillion, will put even greater strain on the Treasury. Source: Bank of England. But what exactly has Reeves done to face accusations that this crisis is of her own making? According to the Bank of England, sharply raising the national minimum wage and increasing employers' national insurance contributions have driven up food prices. Labour's labor rights reforms are unsettling investors and slowing growth. Inheritance tax hikes have weakened the economy further, and the new packaging levy, aimed at achieving net zero, has not only deterred investment but also pushed up shop prices. Source: Bank of England. So here's a question for you. Were these measures truly to protect workers, or have they harmed both the job market and the economy? The financial outlook continues to worsen. The bank warns that Reeves's tax increases last year have weakened the job market, slowed growth, and driven prices higher, especially in supermarkets, pushing inflation to 3.6% in June, up from 3.4% a year earlier. Source: Bank of England. In a controversial move, the Monetary Policy Committee, led by Andrew Bailey, voted to cut interest rates from 4.25% to 4%, but only narrowly, with 4 out of 9 members opposing the cut. Meeting minutes revealed concerns that inflation could spiral out of control if rates are lowered too quickly. Source: Bank of England. To make matters worse, the bank forecasts inflation peaking at 4% in September, double the official target, and remaining high until 2027. Energy and food prices are set to rise sharply, with food particularly affected by domestic policies such as higher taxes and wages, rather than global markets. Source: Bank of England. Measures in last year's budget, such as raising national insurance rates and lowering the earnings threshold for contributions, have hit shops and supermarkets hard. The Extended Producer Responsibility, EPR packaging levy, has already pushed prices up, even before official bills are due in October. Source: Bank of England. The bank expects food prices to rise by as much as 5.5% this year, while the British Retail Consortium predicts a 6% increase. Worse could follow if Angela Rayner implements her plan to raise wages for 18-20-year-olds to match those of over 21s, a jump of more than 20% in the cost of employing this age group. Source: Bank of England, British Retail Consortium. So do you think such a wage rise would help the economy, or would it cost young people their jobs? The bank also warns that these policies could fuel inflation further, triggering higher minimum wages in the future, and that inflation-linked benefits could rise by 4% if forecasts prove accurate. Source: Bank of England. All this makes the bank extremely cautious about cutting interest rates, yet it knows the economy is fragile and needs a boost. However, businesses surveyed by the bank are holding back on investment due to high taxes, the increased minimum wage, and labor rights legislation that could cost firms $5 billion. Source: Bank of England. Even Alan Taylor, one of the more dovish members, wanted a bigger rate cut but reversed course in a second vote over fears of a possible recession in the coming years. While he expects inflation to fall eventually, he admits that Reeves's taxes may not be as temporary as she claims. Source: Bank of England. NIESR has warned that significant tax rises are coming, possibly exceeding the $40 billion Reeves raised last year, meaning that the cycle of inflation and stagnation could return in full force, creating a deadly stagflation scenario. Source: NIESR. Final question: If you were in the government's shoes, how would you tackle both inflation and stagnation at the same time?